Zero DTE SPX spreads. These are a strategy I've tested for a really long time, and here are three super common mistakes when it comes to them and some ways we can overcome them. What's up, everybody? Eric here. Welcome back to All the Outliers. And we were talking about a super common strategy today. A lot of people I know like to trade this strategy, myself included, but there are some really common errors people make. So first, let's get a quick baseline on what this strategy is. The zero DTE SPX strategies, there's a ton of different forms and fashions of them. Sometimes people will trade short strangles. Sometimes they will trade short straddles. Sometimes short iron condors that are far out of the money, so on and so forth. There's a lot of variations, and I'm not going into all of them today. What I do want to talk about today are some of the more common variations and the issues with them. So one of the most common variations I've seen is essentially a short, wide, far out of the money iron condor. So what that looks like is if I come over to the trade tab, I typically would see a zero DTE. Obviously it's the weekend, right? Well, not obviously, you would know that. I know that. Today's the 23rd of October. It's Sunday. So there's no zero DTE right now, but normally there would be. So let's just pretend that this one DTE is actually zero DTE. We would pop this open, and then a lot of people go super far out of the money for the short option. So let's start with the put side. And let's say we go to this 10 delta far out of the money short put, and then you would buy an even further out of the money long put, essentially to create a hedge. Now, there's a couple big issues with this. The first one is the use of spreads, in my opinion, is an inefficient way to trade this strategy. What is this strategy anyways? Why do we trade it? In short, what we're attempting to do is harvest the volatility risk premium. And what that means is if I zoom in on a slightly shorter time period and we look down at this weird looking series of lines, I am charting out implied volatility versus historic volatility. That is the entire purpose of the zero DTE strategies, is we are attempting to trade the typical overstatement of implied volatility to historic volatility. The problem is we are making the assumption that implied volatility is high relative to historic volatility. That is why we sell premium in these strategies. The big problem is if you're trading a spread, okay, we're selling the volatility in this 10 delta short put, but then we're buying the very same volatility that we think is overpriced. That's the first problem. People are uncomfortable taking risk, so they seek to hedge out this risk using spreads like this. And that is an issue because you are literally contradicting the entire trade hypothesis that you're starting with. Now, to be abundantly clear, that is not to suggest that all spreads like this, vertical spreads or condors, are immediately contradictory in nature. For some people, they will use that far out of the money wing just as a way to hedge black swan risk. No problem. If we want to do that, let's use some data to inform our decision cycle. And what I mean by that is maybe we only do it on the put side because markets tend to move down much lower, far more aggressively than they do to the upside. So if that's our concern, instead of just automatically doing some sort of condor, maybe we only do it on the put side where the risk typically lays. But for me, more frequently than not, I would prefer just to use short straddles or short strangles. Typically, a short straddle is better off, in my opinion. Next one, non-discerning entry. This is the most important one out of this list. I put it number 2 in case you want to jump ship early, which you shouldn't. You should stay to the end because the last one's actually really interesting in conjunction with the first one. But let's talk about the second one. Non-discerning entry. If I look at these different lines, you'll notice I have a bright yellow, a dark yellow, and then a white. The white line is implied volatility, and then the historic volatility that's more pertinent to this conversation is this brighter yellow, which is the 30-day. Now, you'll notice there are periods of time where the actual historic volatility is greater than the implied volatility. So if we simply just every single day trade this strategy, you are indiscerningly throwing out something that's supposed to capitalize on a specific environment, and some of those environments it doesn't. So we need to pay close attention to the relationship between implied volatility and historic volatility, again, based on the time frames that you're trading. But this entire strategy is predicated on implied volatility typically being slightly overstated compared to historic volatility. So if you just randomly wheel this strategy all the time because it's the only thing you know, you are using the strategy in periods of time where it actually doesn't make sense. So you got to pay attention to that. Okay, the last one is some people do this really interesting thing where we kind of combine both of these entities, meaning we use spreads to spread off our risk, but then we also put stops on those spreads. The problem with this is as soon as you start integrating stops into this kind of strategy, the numbers change significantly. And I know what you're saying, Eric, I've seen it back tested. It looks great. The problem with back tests on strategies like this is they miss things like slippage. They're not super specific to the strategy as it is. And again, unless we get very, very pointed with our back testing to include periods where implied volatility actually is overstated compared to when it's not, using stops on these spreads essentially kneecaps the strategy. You are trying to capture a variance in volatility, but then you're not giving the trade the space it needs to move. And I've actually done videos dissecting this more in detail. But the fact of the matter is, stops on spreads, again, not saying it's always the wrong answer, but you got to look really carefully at what's happening to the expectancy of the strategy. What ends up happening with this kind of setup more often than not, especially if it's coupled with all three of these in conjunction with one another, is we run into a scenario where we are taking a lot of very small profits and we're taking fewer big losses, but those losses tend to overwhelm the majority of those frequent small profits. So it's not as simple as set this strategy up because you saw it somewhere, run and gun, and you'll make a bunch of money. There's more to it than that. And if you've been trading for any period of time, you probably guessed that, because far more frequently than not, things tend to be a little deeper as you peel back, especially this second one. If you are trading this kind of strategy and you don't actually have a volatility edge, you are literally hoping. And that is a awful strategy to make money in the markets. So couple things to keep in mind. There's obviously some ways you can circumnavigate these different issues that I've listed out, but the name of the game is optimize the strategy and become discerning. This is not just to throw it out all the time because it's mechanical. The issue is if you blindly follow something mechanically, you step into periods exactly like this that don't make any sense for the strategy to be deployed. So if you made it to the end, make sure you like and subscribe to the channel. Share your thoughts with me, especially if you use this strategy. I'm curious how it's worked out for you. And until next time, be an outlier. See y'all later.